Hi, this is Adam Khoo here, and welcome to the second installment of this lesson on the bull market in stocks is back, strategy playbook edition. We'll be talking about how I'm managing my portfolio in the markets right now. Now, if you have not watched my first video on the bull market in stocks is back, go watch it right now. That's right, turn this off, watch that first video, and come back to this. Alright, so in my earlier video, I talked about the fact that the current bear market is dead and we have just given birth to the new bull market. Now, this is not according to my definition, this is the official definition. Why? A bear market is defined as a drop of 20% from the high of the market. So you can see that was the high, beginning of the year 3393, and we fell into a bear market in record time. Alright, so it hit the 20% mark, so officially we went into a bear market right here. Then the market continued going all the way down to minus 36% from the high, which is the average drawdown of most bear markets in the past 100 years. And then something happened. It hit a low of 2191 and the market started reversing on bad news. So no matter how much bad news there was, high unemployment, market kept going up. Now, a bull market is defined as a 20% rise from the low of the market. Now again, this is not my definition, it's the official definition from Dow theory. So this, as you can see, is the 20% mark from the lows. And we achieved that. So since we hit the lows, the market surpassed that 20% mark and we are right now here, which means by definition, the bear market is dead and the bull market has begun. Now, this is despite the fact that the economy is already in a recession and it will get worse. More people will lose their jobs, more businesses will go bust. But the stock market doesn't care about that because the stock market is not the economy. The stock market is a leading indicator of the economy where the stock market prices in the future 6 to 9 months from now. So the stock market knows that this recession will not last really long, that eventually things are going to recover and the stock market moves up in anticipation of the recovery. Now, the interesting thing is when I posted that last video, I had like 600 comments and the majority of the comments were bearish and you were saying, no, it's not going up, it's going down, are you crazy? In fact, some people lost their shit. Some people were upset. Like, these were some of the comments, right? This video is irresponsible. This guy's clueless, you're a clown, you're crazy, the market's going back down. Some people really upset. Why so dark? They must be from the DC universe. Anyway, but jokes aside, so why are some people so upset? I wonder why. Could it be that these are the people who actually sold their stocks right at the bottom just before it recovered and they're pissed that they missed the recovery? Could it be that a lot of these people are short on the markets and as markets are going up, they're getting their balls squeezed? I don't know, right? But the interesting thing is this, it's not just a lot of these comments, but when you listen to CNBC and you watch a lot of comments by investment experts, most of them are actually indeed bearish. That's right? In fact, this was something that I saw over here, that 74% of the investment experts are bearish and they believe that the market will hit a lower bottom. And here's the irony behind this. The irony is that when I read all this and I find that most people out there are bearish, they expect the market to go much lower, ironically, that makes me more bullish. Why? Because I've been in the markets for the last 26, 27 years. And one of the things that I realized is that the market tends to do the opposite of what the majority thinks. That's right. When most people think it's going to go down, down thing goes up. When most people think it's going to go up, down thing goes down. And one of the things said by Jesse Livermore, one of the greatest traders that ever lived, was that the stock market is never obvious. It is designed to fool most of the people most of the time. William O'Neill from investors.com, right? He says that the market moves to disappoint the masses. Bernard Baruch, I think that's how you pronounce his name, a legendary investor in the past, he said the main purpose of the stock market is to make fools of as many men as possible. So why does the market tend to do the opposite of what most people think? Well, here's the reasoning behind that. Now remember, what drives stock prices are demand and supply, right? So when there's more demand for stocks than supply of stocks, prices go up. Okay? When supply of stocks, that means there are a lot of people selling shares, exceeds demand, what happens? Price goes down. Correct? Makes sense. Now, when you hear that the majority of people are bearish, majority of people expect the market to go down now, what do you think they have done? That's right. That means most people have already sold their shares or they have shorted the market. So in other words, there are a lot of short positions out there. In other words, there are a lot of people who have sold their shares. There are very few people holding on to shares right now. So in other words, is supply or demand higher right now for shares? The answer is supply is very, very low right now. Supply is very low because there are very few shares available for sale. Because those that are available for sale have already been sold. Does it make sense? So there's very little supply of shares out there. So in other words, right now, as the big value investors, they begin to see value in the markets. They say, things are undervalued, right? And they believe in the recovery. What do? They're going to buy shares. People like me, right? So once you've got a bit of buying, a bit of demand, and because there's so little supply, once the demand exceeds the supply, stock prices rise. And that's the reason why the market goes the opposite of what the majority think. So as a professional investor, what's my strategy right now? How do I manage my portfolio? What's my playbook? So before I share that, let me make a disclaimer in case people accuse me of being irresponsible, you're going to tell people do the wrong thing. Hey, here's my disclaimer. I'm not giving financial advice. I'm not telling you what to do, for goodness sakes. I'm not a licensed financial advisor. I'm a professional investor investing my own money. I've got my own skin in the game. I'm just sharing with you what I do, right? Should you follow me? Absolutely not. Follow your own strategy. Never follow someone else's strategy. This is one of my portfolios of multiple portfolios that I have, and you can see that I put my money where my mouth is, right? So I buy shares almost every single day. I've got multiple accounts. One of my accounts, which is about $841,000. It was about 900 grand at the beginning of the year, so slightly down because we're down from the highs, but eventually it's going to be 900K, a million, 2 million, 3 million, a lot higher. Really confident of that. And this is one of my other small accounts, which is about 400 grand. And again, you can see that most of my positions are now above water because I was adding shares right at the bottom of the market last week. Okay, so what's my playbook? What am I going to do now moving forward? So let's go back and take a look at the charts. All right, there we are. Okay, so like I said, right, officially the bear market is dead and officially the bull market in stocks has begun. Now, people have been asking me this question, Adam, how long do you think this bull market is going to last? 1 day, 1 week, 1 month, 1 year? I don't know, right? I can't predict the future. Now, is it possible that this bull market lasts for a few days, dies, and the bear market comes back? Sure, everything is possible. Haven't you watched those horror movies where you kill that monster, that bear, whatever it is, and the guy resurrects and comes back for a second round? Of course it's possible. And that's why as professional investors, you always got to have a plan A, a plan B, and a plan C. So you know exactly what to do in every single scenario. So that in every scenario, you win, you make money. It's not whether you're right or wrong. It's how much you make when you're right and also how much you make when you're wrong. I'm going to show you how I do that right now. So let's look at the charts. So again, this is the S&P 500. And so let's look at the various scenarios. And the first scenario is that the bull market continues all the way to the previous all-time high and continues to a new all-time high. That's the first scenario. So in this scenario, would I add shares right now? No, I won't, all right? I've already added shares somewhere there. If you looked at my previous video, I've also been adding shares almost every day over here. Now, would I add more shares right now? No, I won't. By the way, if you want to know exactly when I add shares, you can subscribe to the Ultimate Investors Playbook. And in the private Telegram chat group, right? You get to see me invest live every single day, right? Anyway, so like I said, I won't add shares right here. Why? Remember that nothing goes up in a straight line. Okay, this will not go up in a straight line. What goes up must come down before going higher. You got to see a wave pattern. So we've got wave up, wave down, wave up, wave down, and so on and so forth. So right now, over here, we have a wave up pattern, and we've got a wave down. So this is a wave up. Never buy on the wave up. Wait for the wave down. So you got to wait for wave down first. Now, how much would it drop? Okay, now no one can predict for sure, but one way is to use Fibonacci ratios. Okay, so we call this the start of the impulsive wave A, and if we get a reversal pattern over here on Monday, that would be the end of the impulsive wave. So it would retrace. Now, we can use Fibonacci to kind of like guess the retracement. So click on A, drag to B. So it should retrace to the 50% or the 61.8% level. So we are expecting a wave down to here. And what we want to see is we want to see it make a low higher than the previous low. So if we start to see higher highs and higher lows, that would be very bullish. And then we could add more shares here to catch the next wave up. And of course, you get a wave down, add more shares, wave up, and it continues. Again, bear in mind when I say add shares, well, you could, as an investor, just buy the S&P 500 ETF. No worries. But if you buy individual stocks, you got to be careful. Not all stocks will recover. Some stocks will drop and never come back. Okay, you got to be really careful, right? So, I highly suggest learn how to pick fundamentally good company stocks. That's what I teach in my value momentum investing course, the whale investor, for example. So for me, I will never buy airlines. I don't know why on earth Warren Buffett bought airlines. To me, it's too competitive an industry. I'll never buy those cruise stocks. I wouldn't buy oil and gas stocks. Why? Because these companies, their balance sheets are very weak. They are losing money every day. They could go bankrupt. They may never recover, right? So I want to only own shares where their sales and profits are hardly affected by the lockdown. In fact, their sales and profits may be boosted by the lockdown. For example, when people are at home, they have to order things from Amazon or Alibaba. They still go on Google, they go on YouTube, they go on Netflix. We call this the recession-proof stock. So these are the stocks that I buy, because these stocks, their sales and profits continue to rise in a recession, and they've got very little debt, very strong cash. So you know that even if it goes down temporarily because of some panic in the markets, it will go higher eventually. And these are the only stocks that I want to have in my portfolio. Does this make sense? Right? So like I said, when I say add shares, you got to add the right shares. You add the wrong shares, it's going to go down and never ever come back. Okay? So again, that is scenario number one, right? The bull market continues. We go back to all-time highs probably in July, August, and we make new highs. And hallelujah. Now, that's the first scenario. Second scenario, again, everything is possible. Remember that as an investor, okay, you got to always have a plan B, right? No matter how much you believe in plan A. It's kind of like no matter how much you exercise and eat right, you got to buy health insurance because shit can happen that you don't expect, right? No matter how much you love that person you get married, always have a backup plan, right? Have a prenuptial agreement. So if shit goes wrong, you can bail out, right? Okay, so what's the plan B? So is it possible that this bull market does not last very long and the bear comes back for a second round? Sure, it's possible. So we have to watch this level where this bear market that started, right, we could be going down. This could be a short-term bull market that hits the resistance and it makes a new low over here. So what is this level? Again, we use Fibonacci to calculate. So if we take this as the A, start of the impulsive wave, B, the end of the impulsive wave, where is the level of resistance. It'll be here, right? So click on A, drag to B. There we go. So that's the 50% retracement, 61.8% retracement. So these two levels are very important levels to watch. You can see right now, we are right at the 50% retracement level. So many bearish people, they think, hey, it's hit the 50%, right? And it's gonna go all the way down to make a new low, a double bottom. Of course, everything is possible. It could happen, okay? So for me, what am I watching? I'm watching this level over here. Remember, like I said, this will likely go down. But again, if it goes down and makes a higher low than this, then the bull continues. But if this goes down and closes below this low, right? If it closes below this low, ooh, then it's a chance the bear resurrects and we make a new low. That is possible. Now, if this happens, what do I do as an investor? Very simple. If it goes even lower, I'm happier. Why? Because I've got fundamentally very good companies. And if it's cheaper now, I buy more shares. See, when you own very good companies, you don't care if it goes lower. Because you know that eventually it's going to go much, much higher in a year or two. Because they are fundamentally good companies. Not the airlines, not the cruise companies, not the oil companies, they may never recover. But good companies will always go up. So I'll buy more shares. So if it goes up, I'm happy. If it goes down, I'm also happy. I'll buy more shares. But at the same time, if it goes down, I also want to make some short-term profits. So that's when I use options. Okay, so I'm a big options trader. I use put spread options so that when the market goes down, I'm generating short-term profits, and I can use the short-term profits from my put options to buy more shares at a lower price. And that's why I say as a professional investor, you make money in any direction. It goes up, you're happy. It goes down, you're even more happy. Who cares where it goes? Because in the long run, you will always make money if you hold great companies and you learn to short the market to make short-term profits if it goes down. All right, now let me show you how I use put options to generate profits if we close below this low and we make a double bottom, all right? Now again, if you have not learned options yet, you can always take my professional options trading course. They're available at Piranha Profits. But anyway, let me show you what I will do right now. So what level is this? Let me draw a line to determine that level. So this level is about 2440, okay? So like I said, if the market closes below 2440, I will go short using put options and make money as it goes down to make a new low at, whatever, maybe it may go down to 2180, for example. It may even go down to 2000, right? That is possible if we make a 50% drop from the top. Okay, so what I do is I will then go to my trade tab over here, and I could buy a put spread option that lasts for say 30 days. Okay, say 32 days. Okay, so I'm looking at put options. I'm looking at 32 days to expiry, and I'm looking to buy the 2440 put options and simultaneously sell the 2180 put options. Because when I sell these put options, I collect the premium to finance my 2440 put options. So that lowers the cost of my short trade. So let me show you how that's done. So let me look for 2440. Okay, there we go, right? So 2440, I'm gonna click buy, and I'm gonna buy a vertical spread. Okay, all right, so 2440, and my target price, let me see where it is again. So my target price could be 2190 or 2180. Let me check that out. So it could be 2180. Over here. Okay, So you can see that by taking this trade, how much would it cost to take this trade, the short trade? It would cost $22. All right. Now, one contract is 100 shares of the S&P 500. So one contract would be $22.45 times 100. It will cost me $2,245 to buy one contract of these put options. So the worst that can happen is that is my cost of insurance. Okay. Now, if the market does go down, how much money do I make? Let me show that to you. So I'm going to click send over here, and you can see that my maximum profit from the trade is $23,000. That's right, $23,000. $23,700. And how much does it cost for the trade? My maximum loss is $2,000. 2,245. Okay, so that's not bad. So that's a risk to return ratio of 1:10. So if the market goes down, I'm betting $1 to make $10. So every contract I buy, I'm going to make $23,000. If I buy 10 contracts, I'm going to make $250,000. So I'm pretty happy if it goes down. I make $250,000. I take that $250,000 profit. I buy more shares of good companies. When it goes up, eventually I make even more money. Right? So that's really cool. Now, if $2,000 is too much money for you, and you say, I can't afford $2,000, no worries. You can buy put options on the S&P 500 ETF, which is the SPY, which will be 1/10 the price. So instead of $2,000, you only have to use about $200 per contract. So you can also do that as well. So again, if you're interested to learn more about how we trade options, check out my professional options trading course. So I do hope this video has given you more insight on how professional investors make money consistently in any direction. See you soon, guys. Stay safe, and may the markets be with you. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.